Ind AS 34 Interim Financial Reporting. The objective of Ind AS 34 is to prescribe the minimum content of an interim financial report, the principles for recognition and measurement in complete financial statements or condensed financial statements for an interim period. Ind AS 34 does not mandate which entities should be required to publish interim financial reports, how frequently or how soon after the end of an interim period. This standard applies if an entity is required or elects to publish an interim financial report in accordance with Ind AS 34. Definition. What is meant by interim period? Interim period is a financial reporting period shorter than a full financial year. What do you mean by interim financial report? It means a financial report containing either a complete set of financial statements as described in Ind AS 1, presentation of financial statements, or a set of condensed financial statements as described in the standard for an interim period. What are the contents of an interim financial report? An interim financial report shall include, at minimum, a condensed balance sheet, a condensed statement of P&L, a condensed statement of changes in equity, a condensed statement of cash flows, notes comprising significant accounting policies, and other explanatory information. What are the forms and content of interim financial report? Form and content. If entity publishes a complete set of financial statements, its form and content should be in line with Ind AS 1 for a complete set of financial statements. If an entity published condensed financial statements, statements shall include headings and subtotals included in most recent annual financial statements, and it should contain additional line items if there is omission, which would make their condensed interim financial statements misleading, and present basic EPS and diluted EPS for that period. If an entity's annual financial report included the parent's separate financial statements in addition to consolidated financial statements, this standard neither requires nor prohibits the inclusion of parent's separate financial statements in the entity's interim financial report. Next, significant events and transactions. An entity shall include in its interim financial report an explanation of events and transactions that are significant from the end of the last annual reporting period till the interim period. The following is an list of events and transactions for which disclosures would be required if they are significant. The list is not exhaustive. First one, the written down of inventories to NRV and reversal of such written down, if any, recognition or reversal of loss from impairment of financial asset, PPE, intangible assets, reversal of any provisions for cost of restructuring, acquisitions and disposals of PPE, litigation settlements, corrections of prior period errors, any loan default or breach, related party transactions, changes in classification of financial assets, changes in contingent liabilities or contingent assets, other relevant disclosures. These are the list of events or transactions for which disclosures would be required if they are significant. Periods for which interim financial statements are required to be presented. Interim reports shall include interim financial statements either condensed or complete for periods as follows. In case of balance sheet as of the end of the current interim period, and a comparative balance sheet as of the end of the immediately preceding financial year is required. In case of profit or loss, statement of profit and loss for the current interim period, cumulatively for the current financial year to date, comparative statements of P&L for the comparable interim periods, that is current and year to date of the immediately preceding financial year is required. In case of statement of changes in equity, statement of changes in equity cumulatively for the current financial year to date is required, and a comparative statement for the comparable year to date period of the immediately preceding financial year is required. In case of statement of cash flows cumulatively for the current financial year to date is required, and a comparative statement for the comparable year-to-date period of the immediately preceding financial year is required. For an entity whose business is highly seasonal, financial information for the 12 months up to the end of the interim period and comparative information for the prior 12 months period may be useful. Following is an illustrative example to understand the periods for which interim financial statements are required to be presented. Scenario A: entity publishes interim financial reports half yearly. The entity's financial year ends on 31st March of the financial year. The entity will present the following financial statements, condensed or complete, in its half-yearly interim report as of 30th September 2022. Format is name of the component, current period, comparative period. Balance sheet as at 30th September and 31st March. Statement of P&L 6 months ending 30th September and 30th September of the previous year. Statement of cash flows 6 months ending 30th September of the current year and 30th September of the previous year. Statement of changes in equity 6 months ending 30th September of the current year and 30th September of the previous year. It will be presented. Next, scenario B: entity publishes interim financial reports quarterly. The entity financial year ends on 31st March of the financial year. The entity will present the following financial statements, condensed or complete, in its quarterly interim report as of 31st March 2022, 31st September 2022. Format is name of the component, current periods, comparative periods. Balance sheet as at 30th September 2002 and 31st March 2002. Statement of P&L 6 months ending and 3 months ending. 6 months ending on 30th September 2002, comparative 30th September 2001, and 3 months ending 30th September 2002 and 30th September 2001. Statement of cash flows 6 months ending 30th September 2002, comparative 30th September 2001. Statement of changes in equity 6 months ending 30th September 2002 and comparative 30th September 2001. Next, recognition and measurement. Criteria, recognition and measurement. Same accounting policies as annual. An entity shall apply the same accounting policies in its interim financial statements as are applied in its annual financial statements, except for accounting policies changes made after the date of most recent annual financial statements. Next, revenues received cyclically or occasionally or seasonally. Revenues that are received seasonally, cyclically, or occasionally in an interim period shall not be deferred to other interim periods if deferral would not be appropriate at the end of the entity's financial year. Examples include dividend revenue, royalties, and government grants. So, deferment is not permitted. Certain entities earn more revenue in certain interim periods of a financial year than other interim periods. Such revenues are recognized when they occur. Next, cost incurred unevenly during the financial year. Costs that are incurred unevenly during an entity's financial year shall be deferred for interim period purposes if and only if it is also appropriate to defer that type of cost at the end of the financial year. Example: prepaid rent, prepaid insurance, prepaid property taxes. So deferment is permitted provided it is appropriate. Next, measuring interim income tax expense. Income taxes are assessed on an annual basis. Interim period income tax expense is calculated by applying to the interim period's pre-tax income the tax rate that would be applicable to expected total annual earnings, that is, estimated average annual effective income tax rate. The estimated average annual rate would reflect a combination of a progressive tax rate structured expected to be applicable to the full year's earnings. The tax rate includes enacted or substantively enacted changes scheduled to take effect later in the financial year. Ind AS 12 income taxes provides guidance on substantively enacted changes in the tax rates. The estimated average annual income tax rate would be re-estimated on an year-to-date basis. The standard requires disclosure of significant change in estimate. To the extent practicable, a separate estimated average annual effective income tax rate is determined for each taxing jurisdiction and applied individually to income of each jurisdiction. Similarly, if different income tax rates apply to different categories of income, such as capital gains or income earned in particular industries, to the extent practicable, a separate rate is applied to each individual category of interim period pre-tax income. While the degree of precision is desirable, it may not be achievable in all cases, and a weighted average of rates across jurisdictions or across categories of income is used if it is a reasonable approximation of the effect of using more specific rates. Restatement of Restatement of previously reported interim periods. A change in accounting policy other than one for which the transition is specified by a new Ind AS shall be reflected by restating the financial statements of prior interim periods of the current financial year and the comparable interim periods of any prior financial years that will be restated in the annual financial statements in accordance with Ind AS 8, or when it is impracticable to determine the cumulative effect at the beginning of the financial year, adjusting the financial statements of prior interim periods and comparable interim periods to apply the new accounting policy prospectively from the earliest date practicable. In case of accounting estimate, if any change in accounting estimate is done during current interim period, the effect of such change should be given from the current interim period only. That is, prospective accounting should be done. Interim financial reporting and impairment. An entity should not reverse an impairment loss recognized in the previous interim period in respect of goodwill